The purpose of today's webinar is to provide information to states for effectively partnering with program administrators and lenders for their RLF programs. We recognize that states may be at varying stages in the process. Some are just beginning, others are further along, and so the webinar content here today is aimed at both segments. We have a Q&A session after the presentation for general or clarifying questions from today's presentation. Use the chat feature to post questions. Greg and Jeff will be monitoring questions in chat and will tee these up for addressing during Q&A, or may offer responses directly in chat. We have scheduled office hours on May 31st at 1 p.m. Eastern Time, so states can ask additional questions, more in-depth questions, or program-specific questions. You should have received an email communication from DOE about this. We encourage states who plan to participate in the office hours to register so we can gauge the number of attendees in advance. That said, don't let the lack of pre-registration prevent you from joining if you have questions. We also have a webinar scheduled for June 25th and a follow-up office hours session scheduled on July 12th to discuss building successful partnerships with energy auditors and project contractors. Lastly, as a reminder, free direct technical assistance services are available through Berkeley Lab. The process for submitting a request is noted here on the slide. Bear with me 1 second here, folks. Okay, the agenda for today's webinar will include a review of terminology, a review of the role of partners during the RLF program lifecycle, a review of the characteristics of good partnerships, a review of the goals and objectives for partnerships with both program administrators and lenders, a review of some tactics and best practices for these partnerships, and then we'll have our Q&A session. We're using the term partnership, so let's define what we mean by that term. A partnership can be defined as an arrangement where 2 or more parties agree to cooperate to advance their mutual interests. State energy offices are looking to implement revolving loan funds under the Energy Efficiency Revolving Loan Fund Capitalization Grant Program. Some state energy offices may need a program administrator partner to help them design and/or administer the program or certain elements of the program. Depending on the revolving loan fund structure, the state energy office may also be looking to partner with 1 or more lending organizations who can make loans to borrowers with support from the state energy office revolving loan fund. State energy offices will also need partnerships with energy auditors who will perform the energy audits required under the program, and with project contractors who will install retrofits. The state energy office benefits from partnerships with program administrators by accessing expertise it may not have within its current staffing. Building this expertise internally might be time-consuming and costly, and it may be more cost-effective and more practical for some state energy offices to outsource this. The program administrator benefits by receiving fees for its services and potentially by building its brand through its role in administering a state program. The state energy office benefits from partnerships with lenders in a similar fashion. Most state energy offices are not currently staffed with personnel with experience in originating and servicing loans. Critically, the state energy office also stands to significantly expand the impact of its program through partnering with outside capital providers, thereby leveraging its internal funds. The lender benefits by earning returns on its loans, which are generally supplemented in some way by program funds. Lenders, particularly community-based lenders, can also build brand through these programs and forge new or deeper relationships with borrowers. Mission-oriented lenders will also appreciate the opportunity to participate in a public program that creates environmental benefits and lowers customer energy bills. This next slide shows the general phases of an RLF program lifecycle and describes the activities that occur in each phase. The slide shows the timeline from the perspective of the Energy Efficiency Revolving Loan Fund Capitalization Grant perspective, including the 180-day requirements. But this timeline generally aligns with RLF planning phases. In phase one, the State Energy Office assesses market gaps and opportunities to increase demand, sets program goals, identifies its target market sector, and determines its proposed RLF structure and program design, and ideally receives feedback on its approach. In phase two, the State Energy Office establishes its partnerships by working through its process for partner selection and approval, developing agreements and processes, and readying for program launch. In phase three, the program is executed, and the State Energy Office works with its partners to implement, monitor, and adapt program activities. In this slide, I'll talk about 6 characteristics of effective partnerships. They aren't uniquely related to RLFs, but they apply to partnerships with third-party administrators and lenders for RLF programs. Open communication is the backbone of any effective partnership. Each party depends on the other to keep informed. This can be achieved by offering regular status reports or status meetings. It's better to over-communicate and be transparent than to keep one another in the dark and be surprised or confused if an issue arrives. For revolving loan funds, state energy offices should have regular communications with the program administrator and program lenders to find out what's working well and what issues need to be addressed. The next characteristic is accessibility. Signing a deal is only the beginning. Implementation is where the heavy lifting starts. Access to the right team members is the difference between a partnership that yields results and one that is just on paper. Both partners should identify and discuss accessibility to the people that do the work and ensure that these individuals are accessible to one another. The next characteristic is flexibility. It is important to keep your overall goal front and center, but it's also good to acknowledge that the likelihood of everything going as planned is unlikely. Being prepared and flexible is the key to overcoming curveballs in partnerships. Make sure both parties discuss how to handle an unexpected situation so that principles and processes can be developed to deal with these situations if they reoccur. Next is complementary strengths. The most impactful collaborations stem from complementary strengths. Recognize that lending partners have experience in effectively serving their borrowers and customers. State energy offices may have experience with helping building owners with technical assistance to offer clean energy solutions. Program administrators likely have experience with effectively managing the different functions a program requires, from loan and project approvals to interfacing with a contractor workforce to tracking and reporting outcomes. Some state energy offices have in-house expertise and staffing resources across some or all of these functions. Others may not. Determine how to merge the expertise of partner organizations to bring about effective solutions and processes for your program participants. Next is measurable results. Partnerships can create great outcomes, but require commitment and resources. A plan for measuring outcomes helps assess the success of the partnership and should be included in every agreement. Financial key performance indicators can be used to determine the monetary value of the partnership, such as leads generated, active deals, or completed loans. Strategic key performance indicators, such as customer awareness, engagement, and satisfaction, can be more difficult to measure, but are still important when determining partnership impacts. The last characteristic is commitment. Both entities must agree to pursue mutual success and then put action behind the words. If you promise something by a certain date, then meet that deadline. If you plan to provide something to your partner, commit a date by which you expect to respond. Commitment may involve renegotiating certain terms and conditions, adjustments to resource allocations, reordering steps in the implementation process, or it could involve reordering roles of team members. These are challenges, but they're not insurmountable as long as everyone maintains the same level of understanding and commitment towards achieving the agreed upon goals. The goals and objectives for partnerships with program administrators are typically to obtain experienced resources to supplement internal staff resources. It's about expertise and/or capacity, and it can be it can be for various aspects of the program, including program design or implementation of some or all of the program's operations, including loan and project approval, reporting, or interfacing with energy auditors and contractors. This usually comes about after an assessment of self-administration versus partial or full outsourcing. Included on this slide is a table that we presented in the September 2022 RLF Bootcamp. It shows the advantages, disadvantages, or pros and cons from different program administration models. If you fully self-administer the program, you control the program delivery, but it is then incumbent that you have sufficient resources and expertise. If you fully outsource your program, you can alleviate staff burdens or expertise, but then you will have less control over the program delivery, and you'll need to establish effective oversight of the program administrator's activities, and finding the right service provider can be hard. The option in between these two bookends is to outsource some, but not all, of the program administration functions. It's also worth noting that state energy offices who outsource responsibilities are still ultimately responsible for program delivery as grant recipients, and they need to monitor the activities of their partners. Some states use a litmus test that if it costs less to bring in a consultant than it would cost for the state energy office to set up systems and staffing needed to implement a program or a process, then choosing to outsource means more funding that can go to deliver program services. For partnerships with lenders, the objective is to partner with experienced and reputable lenders who can meet the objectives of the RLF program. The lender provides a source of capital and can help expand the reach of the program. If the state energy office is using a direct lending structure where it will be the lender making direct loans to borrowers or using a third-party administrator to make loans on its behalf, then it typically doesn't require a partnership with a lender. But if the state energy office proposes to use a co-lending, interest rate buy-down, or a loan loss reserve structure, then effective partnerships with one or more lending partners is essential for the program. In each of these structures, a third party makes the actual loans to customers. Now we'll review some tactics and best practices for partnerships with both program administrators and lenders. For partnerships with program administrators, you first need to define the partner's role. The partner could be engaged to just provide program design services for the state energy office to administer. Or the state energy office could engage a partner to provide program administration services for a program design that's already been established, or perhaps by replicating a program design used by another state. Typically, we see state energy offices engaging a partner to provide both design and administration services. Or it could be for administration of discrete program subcomponents or tasks. These subcomponents could include the recruitment, training, and support of program lenders, energy auditors, or project contractors, could include program marketing, could include federal grant compliance monitoring, such as Davis-Bacon Act, Buy America, Build America, or NEPA, or tracking and reporting loan and project outcomes, or other tasks and program subcomponents. You need to determine whether competitive bidding is required for selection of a program administrator. States have different policies and processes for procurement, and we're not proposing to cover these different approaches here in this webinar. But a threshold question to be addressed is the process for selection and approval of service providers. Many states may need to issue a request for proposal to hire a third-party program administrator. Now I'll review some recommendations and best practices for the contents of RFPs to select program administrator partners. First, clearly define tasks and deliverables. Be specific in what you want. Partner with someone on your team that has a solid understanding of energy finance, or seek out technical assistance from the start. Now, this can be an area where the Berkeley Lab team can provide technical assistance to state energy offices. Know from the outset what your end goal is. The RFP should ask for everything you need from a program administrator from start to finish. Key detail items include financing strategy, user experience, data reporting, decision-making processes, and ongoing communication over the life cycle of the program. Being clear up front with all details before the contract is in place sets proper expectations and avoids later negotiations over specifics. One approach I've used in RFPs in the past is to provide proposed tasks and deliverables in the RFP and then ask respondents to respond whether they would propose any changes. You can also ask them to provide preliminary information for you to help evaluate their skills in carrying out some tasks. For example, let's say you have a task in the scope of work that calls for them to develop a program marketing plan. You could require that in the response to the RFP, they provide some examples of marketing approaches they would propose. You're not asking them to develop the marketing plan and submit it along with the RFP, or with their response to the RFP, but it's fair game to ask them for some examples, which you can then use to evaluate in your proposal scoring. I have found that asking proposers to demonstrate some of their thinking and creativity in the RFP submission process can help you make sure you get the right contractor rather than a check-the-box RFP approach. Next, the RFP should provide clear and appropriate minimum requirements to be able to respond to your RFP. Typically, you would want to ensure that the service provider has previous experience providing the services that you seek. Determine how much experience someone needs to have. For example, it could be something like 3 years of demonstrated experience. You should consider both the duration of experience and the relevance of that experience. You may ask for experience with programs generally similar to your proposed program. The trick with this is creating a minimum bar to ensure that only experienced respondents can respond without creating a requirement that unnecessarily limits the number of respondents who meet your criteria and can submit proposals. Next, the RFP should seek information on the proposer's proposed staff, their resumes or work history and experience, and ask them to commit the availability of their proposed resources. You want to be able to gauge whether the resources they've proposed for your program are also working simultaneously on numerous other projects or programs where it could jeopardize the ability of your work to be completed timely. Next, you need to establish the compensation approach that will be used and establish how proposers will submit their pricing information. Now, there are many approaches that could be used in your arrangements with a program administrator. They could be fixed price. They could be done on a fee for services with hourly rates. They could be on a dollar amount per loan or per project, or a percentage of the loan dollars that are issued. I would observe that program design services might be able to be done on a fixed price, but ongoing program administration would likely require an approach that is dependent on your program volume. Lastly, you should request references for similar engagements from the proposer. On this next slide, I'll cover some recommendations for your RFP process. First, consider holding a pre-bidders conference. A pre-bidders conference is an in-person or virtual meeting where prospective respondents are allowed to ask questions to clarify elements of the RFP and where the State Energy Office personnel can respond to these questions. The responses will be heard by all who attend the meeting and can also be captured and posted for access by prospective proposers who did not attend. We used pre-bid conferences at NYSERDA, particularly for complex RFPs, and found them to be an effective way to clarify RFP requirements and to create a level playing field for questions and answers. Oftentimes, state procurement policies may place limitations on any communications to the State Energy Office regarding the RFP other than to a designated contact person. And this is to avoid any communications which could be interpreted to be an attempt to influence the procurement process. If your procurement approach has a designated contact person, this too can be a way for respondents to seek clarifications on requirements that you've listed in your RFP. And the State Energy Office may have processes where any responses provided to questions are posted for other prospective respondents to see. This too can help make sure there's clarity on the requirements of the RFP without giving unfair advantage to any single party. Review whether your procurement policies allow prospective respondents to seek clarifications on RFP requirements. If they don't, then it's critically important that your terms and requirements are clear, because there is no opportunity for prospective bidders to seek clarification, and you run the risk that the bidder's RFP submission is based on misunderstood requirements. Next, you could consider participation of external reviewers in proposal evaluation. At NYSERDA, we regularly involved external reviewers in our proposal evaluation committees. We felt that it helped bring in different perspectives and expertise to the proposal review process. Check to see if your procurement policy procedures could allow for an external reviewer if you think that could help to improve the quality of review of proposal submissions. State energy offices can submit technical assistance requests from the Berkeley Lab team to support work with partners, including support with RFP processes. Next, address the marketing approach for the RFP. Most states have defined processes and systems for how they issue their RFPs. Some states may have restrictions on communications that may occur with potential respondents once an RFP is issued, or even with potential proposers prior to the RFP's issuance. If permitted, prior to the issuance of your RFP, develop a potential bidder list and notify these entities once the RFP is issued. Potential bidders might come about from organizations you may have had communications with about your proposed program, or you might be able to get leads on potential service providers from program administrators you have for other programs. But I will note that finding service providers is hard. This is a very niche service market. It's not like you can Google energy efficiency revolving loan fund program administrators and find a robust list of service providers. And to this end, the Department of Energy, Berkeley Lab, and NASIO are working on an approach to help state energy offices find potential service providers that could support their RLF programs. NASIO plans to issue an RFI that will permit service providers to register on a list of potential service providers who can provide certain categories of services to support RLF programs. Now, importantly, neither the Department of Energy, Berkeley Lab, or NASIO will review or vet or endorse these entities who register on the list. The site will simply allow state energy offices to identify potential service providers who have registered in the service categories that they're interested in. State energy offices will need to follow their procurement policies and review the qualifications of the service providers who have registered on the list. If allowed, they could use the list to contact potential service providers or notify them once an RFP has been issued. Look for an upcoming announcement once this is available. Once your RFP is issued, consider how you can best advertise it. A link to the RFP can be posted on NASIO's website by contacting NASIO and providing a link to the RFP. You could also consider other energy organizations or associations that could advertise your RFP. Lastly, you need to develop proposal evaluation criteria and a scoring rubric for review of proposals that you receive. Included on the slide are some illustrative examples of evaluation criteria you could consider to assess the experience and qualifications of each proposer and its staffing, the proposer's demonstrated ability to work with communities, particularly underserved communities and underrepresented groups, its demonstrated ability to develop and track program metrics, and its proposed pricing. Once RFP proposals are received, they are typically reviewed by a committee of reviewers and are evaluated and scored. At NYSERDA, each reviewer scored and ranked each proposal, along with identifying any strengths and weaknesses. These preliminary scores and rankings were then compiled. The review committee then met to review and discuss. and after discussion, evaluation panel members were allowed to adjust and submit the final score and ranking for each proposer. Our process then determined the sum of the rankings, with the proposer scoring the lowest number being identified as the winner. We found that using rank numbers rather than aggregate scores helped adjust for any differences in grading among reviewers, which graders are easy graders versus hard graders. And I'm just sharing this approach we used at NYSERDA, but you should follow whatever your defined processes are. Now, states can use different approaches for how and when they score each proposer's pricing information. Some states score this after they first score qualifications and experience and other information. Also, some states may handle references differently. Some states may check references for all respondents. Some states may provide scoring based on the feedback from references, and others use references to validate proceeding with the proposer who scored the best through the evaluation process. Once you select your winning proposer, you need to develop the contract. If you included clear tasks and deliverables in the RFP, this process will be relatively easy, as you should be able to use the information you included in your RFP along with any feedback you might have received through the proposer submission. Usually there's then some back and forth between the state energy office and the winning bidder before the contract is signed and finalized. Once the contract is in place, have regular and recurring status meetings with the program administrator to monitor their work, address questions, and look for opportunities for continuous improvement. The dialogue should focus on how things are going and what issues have come up that should be addressed and considered for continuous process improvement. Also, watch for red flags, which could include things like complaints from participants about the program administrator's activities or lack of responsiveness. Address these situations early. The revolving loan fund program design should identify how many lending partners you propose to work with. If your program is proposing to use one lender, you may realize benefits from economies of scale and operational efficiencies from having one system, one process, and one set of lending terms. Selecting one lending partner through a competitive process may also allow you to select the best partner. The potential disadvantages with only having one lender is that they may not be able to effectively serve all the markets that you want to serve and may not satisfy your statewide geography. Having one lender might also not create competitive pressures on lending terms that can be created by involving multiple lenders in the program. Lastly, if you hitch your wagon to one lender and later find that they are not effectively meeting your program objectives, you need to terminate the relationship and select another partner. You can competitively select more than one lending partner through an RFP or similar competitive process, which can yield a manageable number of lending organizations to participate in your program, but still having them have different systems, processes, and terms. But this approach could also find that the initially selected partners are not meeting your objectives and require reissuing the RFP. If you propose to have an open program with approval of lenders who apply and meet eligibility requirements, this can result in an unlimited number of lending institutions to participate in the program, including institutions with different geographic and lending focus areas. But the approach could also result in different systems, processes, and terms among the participants. The more successful RLF programs like the Michigan Saves program and the Nebraska Dollar and Energy Savings Loan program have used this approach of an open process for applicant lenders meeting eligibility requirements. If you propose to select one lender or multiple lenders through a competitive selection process, the evaluation criteria you use could include their experience serving the proposed target markets, their experience with clean energy lending, the systems and processes that they would use for their lending operations that could allow you to assess the proposer's ability to provide a quick and easy process for borrowers and contractors, their proposed minimum loan underwriting criteria, unless these are proposed to be fixed for all lenders, and their maximum loan interest rates or other loan terms, again, unless these are proposed to be fixed for all lenders. For programs proposing to approve eligible applicant lending partners, you would need to establish eligibility criteria for applicants. This could include their type of organization, for example, whether they're a bank or a credit union or a community development finance institution or a CDFI, or some other form of lending organization. The principal difference between banks and credit unions is that banks are typically for-profit entities that are either privately owned or publicly traded, whereas credit unions are nonprofit member-owned cooperatives. Credit unions typically open membership to individuals who share a common characteristic, such as the industry they're employed in, the community they live in, or other criteria. Both banks and credit unions are governed by federal and state laws and regulations. Credit unions generally have an objective to improve the financial well-being of their members and serve their communities, and therefore some would say that credit unions are more mission-oriented. In practice, many of the larger and more successful RLF programs have worked with credit unions, which have generally demonstrated more interest in participating in these programs than have banks. Community Development Finance Institutions, or CDFIs, are also mission-driven financial institutions that create economic opportunities for individuals and small businesses, quality affordable housing, and essential community services. These entities have also generally been more likely to participate in RLF programs. There's also a variety of other type of lending organizations like nonprofit lenders, specialty finance companies, or consumer finance companies. In practice, some of the larger RLF funds have generally allowed banks, credit unions, and other financial institutions to participate, which generally speaking would include CDFIs, but may not include some of the other types of organizations that I mentioned. You could also use criteria to require that any participant institution must be regulated as a financial institution or a lending organization by either the federal government or your state government to participate. This, too, would likely limit participations to banks, credit unions, and CDFIs. We used this approach for an NYSERDA small business lending program because we wanted to have objective eligibility criteria for participation, but we wanted to avoid having to approve or vet applicants. So we relied on the certification regulation of lenders by the federal or state government as the eligibility criteria for participation. Regardless of which approach you use, all applicants should be authorized to operate as lending organizations and be in good standing with the state. Now, before proceeding to issue a competitive procurement to select lending partners through a proposal or application process, we encourage state energy offices to talk to lending organizations in their states to get input on their RLF program design and the proposed partnership approach. Many states have associations of banks or associations of credit unions or associations of CDFIs, and these organizations can be a helpful resource to involve early to provide input on the program design and approach you propose for partnerships with lenders. They can also be effective to communicate to their member organizations to respond to procurement opportunities or to apply to participate as a program lender once the program is operational. Talking to lending organizations wouldn't typically run afoul of any procurement rules, as these organizations themselves would not respond to RFPs, as these organizations themselves don't engage in lending. Instead, they provide support to their member lending organizations. Here's some examples of questions you could ask lending associations or potential program lenders. These first questions get at background information on the lender's typical underwriting criteria, their maximum loan terms, and interest rates that are issued for loans in the state energy office's target market sectors. It also asks which revolving loan fund financing structure could support expanding their underwriting criteria or supporting longer loan terms. These next questions can solicit feedback on the revolving loan fund strategies that the state energy office may be considering. These final questions can solicit feedback on approaches to remove barriers, increase adoption, and ensure equitable access to financing. Here's an example of what a draft program term sheet could look like to solicit feedback from a potential lending partner or lending organization. This type of term sheet format is likely familiar for lenders and lending organizations. I'm currently working with a state where we've presented this type of format to a few lending organizations for feedback on the proposed design for a loan loss reserve structure. After we receive feedback, we hope to provide this example on the DOE resources page. To have an effective relationship with lending partners, you need to have clear roles and responsibilities for the lenders. Now, normally your lenders will clearly do what lenders normally do. They make loans and they service loans or collect loan repayments. Lenders should also be required to comply with relevant federal and state lending regulations. And you should emphasize the need for lenders to provide quick turnaround times that are required to support contractors. The State Energy Office or its program administrator would generally perform project review and approval, and how this intersects with the lender's loan approval and interaction with project contractors. Also, auditor and contractor management, review and compliance with energy audit requirements, and regulatory compliance for things like Davis-Bacon Act and NEPA. You need to monitor your lender's activities on an ongoing basis. Review its periodic loan reporting. Look for red flags like a slowdown in loan volume or an unusual increase in its reported loan defaults. Follow up with the lending partner to understand these trends. Consider regularly scheduled status meetings. And lastly, consider the circumstances or terms that could result in termination of the arrangement with your lending partner. If a lending partner begins to show signs that your program is not a priority to them or isn't following through on your requests, address it and don't be afraid to talk about contingency planning. There's no way of knowing over time if a lending partner will lose interest in participating in your program. You can do your part by keeping regular contact and addressing issues early and directly, but you're not obligated to stay with them if you can end the contract. On this next slide, we've listed additional resources. I'll note that sample agreements and RFPs and other resource documents are available on the grant resources page. As previously discussed, NASIO will be issuing an RFI to seek potential service providers who can provide administrative and support services to RLF programs to register on a provider list developed by DOE, Berkeley Lab, and NASIO. Look for an upcoming announcement once that's available. DOE has also issued different resource documents that have resulted from the Berkeley Lab technical assistance engagement with a few states. There was an RLF pro forma tool announced in March, which is an Excel-based tool that lets states run and compare scenarios for loan portfolios using different structures of RLF support. Additional documents will be forthcoming as we identify documents being prepared for certain states that can be replicated to potentially support needs for other states. Please consider sharing any of your program-related documents with the DOE and authorize them to be shared with others. Reviewing and adapting a document used by someone else is considerably easier than starting from scratch. So please help your fellow state energy offices out by sharing anything that you've created. Lastly, I'll note that the state of Indiana shared a statement of work document they developed to procure a resource for grant compliance monitoring for Davis-Bacon and such. That document hasn't yet been approved and posted on the DOE resources page, but it was shared with states who participated in the peer exchange meetings where that was presented. If you are interested, contact the DOE team to request this document. On this slide, I've provided contact information for the Berkeley Lab team. And that brings us to Q&A. And just as a reminder, if you have any questions, please use the chat feature. And so now I'll ask Greg or Jeff if we have any questions to address.
Thanks, Jeff. I appreciate it. Great presentation. We don't have any questions at the moment. If any folks have questions they would like to add, please add them to the chat. You can also add them to the Q&A. But I will also say just another reminder that we do have the office hours that are going to be held on Friday, May 31st at 1 o'clock Eastern time. And I've put in the chat the registration link to that. There was an opportunity when you registered for this to register for that one as well. But if you're not registered for it, or if you didn't and now you want to, the registration link is there. We did just get one question now. It says, "Hi Jeff, have you heard of states utilizing a CRM or customer relationship management tool to help expedite some of the processes?"
I can't say specifically that I've encountered a state energy office using a CRM tool, but particularly for a lending operation where the lending functions may be also being performed by lending operations. But you do ideally want to have some kind of a tracking tool. So at NYSERDA, we had a third-party loan servicer, and we had that organization share their information with me. So on a monthly basis, we received, a file, if you will, of the status of all loans. And so you could be thinking of something like that kind of an approach, whether or not a state energy office wants to incur the cost and the process of establishing a CRM program. It could be done, but also keep in mind a number of communications are occurring between the lender and borrowers, and the project contractors and the borrowers or building owners. And so the state energy office is not very often in between those communications. Those communications, I think, are occurring in those channels. And so I would just encourage the state energy office to make sure that they're getting regular reporting from their lenders and regular reporting from any contractors that might be participating in the program, to keep them apprised of communications that are occurring with their customers and borrowers.
Thanks, Jeff. And we have a comment here from Leah Wilkes to this from Minnesota, who's going to say that the Minnesota State Energy Office is putting a CRM in place.
Oh, great. I stand corrected. and thanks for that. And Leah, maybe your team might be able to share some information as you further along your process, or help share some of your objectives and some of your design criteria. I think that type of information could be immensely helpful for other state energy offices to consider replicating.
Yeah. And what I can do is I can take that to the people we are literally just like doing all of the knowledge gathering and everything right now.
Mm-hmm.
And so I can let them know that would be of interest,
yeah.
To share more information about this journey that we're on. It's a
Mm-hmm.
long one.
Thanks, Leah. So another question we have from Miracle. Great presentation, Jeff. Curious to know your thoughts on one lender handling multiple loan types, like loan loss reserve and an interest rate buy down.
Well, I by loan types, Miracle might have meant different markets, like one lender serving both residential and commercial, for example, or it could have been one lender using different RLF structure types, like an interest rate buy down coupled together with a loan loss reserve.
Yeah, I think it's the latter.
Okay, and I don't think necessarily that. Well, first of all, if you were going to combine together a loan loss reserve with an interest rate buy down, then necessarily you're doing that with the same lender. Whether it's one lender or multiple lenders is more to the point of whether you think one lender can serve your whole program, all the markets that you want to serve, and serve your statewide geography, or whether that's too much to ask from one lending organization and you really want to benefit by having multiple organizations. And again, as I spoke to earlier, the trade-off is one lender, super easy. One lender, one system, one set of terms, super easy. Every contractor, every borrower is using the same system and the same lender, and you're working with them. But they, over time, you might find them to not be good, and so now you got to replace them. So the alternative of getting multiple lenders in is what I think we've seen more state energy offices do. And then the question is just, are you going to use this, competitive process to select more than one, but a finite number? Or are you going to have an open process where you'll be open to ongoing participation of new participants, provided that they meet your eligibility criteria? But I don't necessarily see those things being tied to your decision on what type of RLF structure that you use, whether it's interest rate buy downs or loan loss reserves or co-lending. I think the number of institutions can handle those, generally speaking, or your competitive evaluation process would determine their ability to satisfactorily handle things like interest rate buy downs along with loan loss reserves. Hopefully that answers Miracle's question.
Thanks, Jeff. We have another question from Eric. We focus primarily on small lenders, but I'd like to hear more if you have any recommendations about the benefits of why it may make sense to only work with one large lender in place of multiple CDFIs, credit unions, green banks, etc.
Yeah. So, and this gets tricky because, like, again, one large lender, well, I guess if you truly go through a process to select one lending partner, then you could be open to any form of lending organization, and whether or not they're regulated, because you're going to have a process where you're ultimately going to select the air quotes around the word best. And you could find the best, the quote unquote best lending partner, who, by the way, might be an unregulated, lending organization, not even a lending organization. I hate to use the expression like Joe the lender, thinking back to Joe the plumber, but the notion of what qualifies someone to be a lender is someone who makes a loan to a borrower. They don't have to be a regulated entity. And in the context of a revolving loan fund program, you could work with a lender who isn't regulated. Particularly if you're only working with one, because you're going to have, they're going to have terms under which they make their loans, and you're providing some form of support to the loans that they make. I'm not advocating for working with non-regulated lenders. I'm just pointing out that, as a matter of your selection process, you can identify the right lender to serve the market that you're trying to serve and the geographical areas you're trying to serve. And whether that's a small lender or a big lender, your competitive process will get the best one lender that meets your criteria.
Thanks, Jeff. From Anna Joy, any tips on combining or coordinating public outreach efforts to maximize community awareness, also known as the lender doing their marketing and the state also trying to market the possible loans?
Yeah, well, I think what that's getting at is, once you have a lending partner or partners on board, can your lending partners also serve as an additional marketing channel partner? And of course they can. In fact, at NYSERDA, we use that approach. We had, in one program, had worked with a community, a regional lender, and we actually had that regional lender send a mailer to like 40,000 customers of theirs who had lines of credit, to make them aware of the opportunity to undertake energy efficiency in their home and to use their line of credit that they have with their bank, right? We thought it was a great, marketing channel, kind of market to their customers. And so those types of arrangements, once you have a lender or lenders, plural, on board, you for sure want to work with those lenders to try to support their ability to market to their existing customers. And then you and or your program administrator and your contractors that are working your program are going to be undertaking various forms of marketing to drive new customers who can become new borrowers and new customers to your participating lender or lenders, plural.
And Anna Joy, I will add here that we actually have a product coming out, a report called Driving Uptake, and that does one of the sort of lessons learned, best practices type of that we see in the market for driving uptake of financing programs is using partnership networks, whether it's lenders or contractors or others. And so we do have a section on that, and that report should be coming out in the next in the coming weeks.
Thanks, Greg. I just want to clarify, not asking about the importance or feasibility of multi-pronged marketing, but more the practicalities of, like, would you recommend this being in the scope of work before we even establish that partnership with the lender? Or is it fine to just have that expectation and later on the nitty-gritty of who's doing what to get the word out gets ironed out? Because I know they have the incentive to obviously have loan partners, but if this is a small pot of money and they're only making so many loans, just want to make sure we have the right parameters of like how much marketing they would be doing, et cetera.
Well, thanks, Anna Joy, for clarifying that. And I think the key question is, and who's paying for it, by the way? Because if you want to, you should encourage your lender or lenders, your participating lender or lenders, plural, to do all the marketing they want. And you should support them and work with them and give them information and help them. The question is, are you going to pay for it? Are you going to pay for them to market, right, to their current customers and borrowers? You certainly could encourage them to market and you could support their efforts. Whether or not you give them, funding is a different matter. But I think trying to clarify in general the way that you see marketing work, and it's probably no one marketing approach. I imagine state energy offices will advertise and market the program. Contractors will certainly market the program, or I should say, market their services to provide services to their customers. And then your lender or lenders, plural, can market to their existing customers. So I do think flagging marketing is for sure something you should do when you're having dialogue with potential partners. How do you do it is up for some discussion. You get some feedback from the lender or lending organization on how they see it working effectively.
Thank you.
Thanks, Anna Joy. And we have a question from Sean. How might the current and near-term interest rate environment impact the appetite of lenders to partner with states? How can interest rate flexibility or design help offset the burden associated with federal requirements?
Yeah, that's a great question. So, I mean, being honest, lenders will probably most likely favor states being willing to use their funds to buy down interest rates, because it frankly is the easiest administrative process for them of the different options that we've laid out, whether loan loss reserves or interest rate buy downs or co-lending. The simplest arrangement is if you're going to be willing to provide funding to them to write down their interest rates. And by the way, it would matter not whether the interest rates are the current interest rate environment, 3 years ago interest rate environment, or what we all think the interest rate environment could be 3 years from now. I think lenders will, generally speaking, probably prefer lowering their interest rates because they'll see that as a more attractive way for them to attract potential borrowers. But the state energy office, on the other hand, wants to leverage its money, wants to achieve maximum impacts. And so the alternative of looking at one of the other structures that we've discussed and presented is probably a longer-term solution, a longer-term better solution to have more leveraged impacts. So I don't know that loan loss reserve arrangements I don't see them necessarily as being better or worse in a higher or lower interest and rate environment than current, except for the fact that generally speaking, higher interest rates could lead to higher defaults, and if higher defaults, then the need for loan loss reserve funding support to a lender could become more attractive. So you could make an argument that leading into a rising interest rate environment, it could be making it more interesting and more appealing for lenders to have a loan loss reserve arrangement with a state energy office.
Thanks, Jeff. Appreciate that. So I don't see any other questions in the chat at the moment. And we are coming right up on the top of the hour. So I would like to thank you for the presentation and for answering the questions. But do want to remind everyone that not this Friday, but next Friday, May 31st at 1 p.m. Eastern Time, we will be holding an office hours in which you can ask Jeff any questions that you want to go over with him in detail. If you have not registered for it, I put a link here, but it is also the same registration link that you used to register for this presentation. And so start coming up with some good questions. I'm sure you all have plenty, and we hope to see you there.
Thanks, everyone. Have a great day.